Good morning. This is Larry McMillan with a stock market update on Monday, December 23rd. So we're coming into the Christmas holiday. We had a pretty big sell-off last Wednesday after the Fed meeting, and it lasted for 2 hours, but a lot of points, almost 250 points on the S&P, and then continued on a bit overnight before halting and then staging a pretty decent rebound on Friday. So it doesn't seem like we're going to have a repeat of that bad pre-Christmas period of 2018. But still, the market did suffer some internal wounds. But the main thing that has become clear once again is that there's support at 58.70. The market probed down to that area, but never closed below it, and it's been a support area now for months. So even if things were to turn bearish, and you will see that we do have some sell signals in place, I'm not really that anxious to sell unless the market can prove to me that it really will trade below 58.70. So for right now, we're still actually holding our core bullish position because that 58.70 is held, and we're quite a bit higher than that right now. Some of the internal indicators, though, that are negative include the equity-only put-call ratios, which have begun to rise finally. And as long as they're trending higher, that's a bearish sign for stocks. Also, breadth has been terrible for a while. We had breadth sell signals a couple of weeks ago. And so breadth descended into very oversold territory, but that's still not a buy signal. It would have to have several days of advances leading declines before that indicator turned bullish. Also, new lows on the New York Stock Exchange have picked up in number. I think there's been more than 100 new lows now for 6 days in a row. So that's not good either, another bearish sign. But as I said, we're not acting on these bearish signs unless S&P proves that it can close below 58.70. The VIX has moved higher, as you might expect, with the sharp sell-off like we saw. And it traded all the way up to 28 and change before backing off some. So that does give us a short-term VIX spike peak buy signal. Those usually last about a month. And we would certainly, we have acted on that actually, but we'll recommend acting on that. But also, there's a potential negative here, and that the 20-day moving average of VIX is starting to rise again. So we'll keep an eye on that. That is not a confirmed sell signal there, though. The construct of volatility derivatives got a little bit worse. I mean, the term structure is flattened out completely, but now they're starting to slope upwards a little bit again, and that's a bullish sign. If the new front month for VIX futures is January, so if January futures start trading higher than VIX February futures, then that's going to be a problem for the market. So far, that hasn't happened either. So we're coming into the very bullish end of the year seasonal period called the Santa Claus rally, which encompasses the 5 trading days of this year and the 5 last trading days of this year, and the first 2 of next year. Typically, the market rises during that period, and so we would expect that to happen again. But if the market should decline during that period, that's often a precursor to some severe selling after that. So it pays to watch this indicator as we're going forward. So tomorrow is a half day on the market. Next Tuesday, by the way, though, is a full day. New York Stock Exchange doesn't do half days on December 31st. They never have, probably never will. So, but this week is going to be a little bit shortened because of that. So I'm assuming you're probably staying home and having a little bit of a vacation. If not, have a great week trading.